Welcome into my Vanguard portfolio update now for the month of May. There's a huge amount that's gone on over the past month. Now we'll look at everything going on in the markets first before we jump into the portfolio itself. Now the biggest news this month has been the reversal of those tariffs on China from the US. But just before we jump into those, let me just put up the markets now to have a quick look at how things are going. So I think the S&P 500 at least has had an absolute stellar last 30 days. You can see on screen now, up around 15% as I'm recording this video. It could always jump, it could always go down, whoever knows. FTSE 100, just having a look from the UK perspective, up 4%, back to where they were around February. And it's almost as if all of this tariff nonsense and tariff mess hasn't happened. And it's been amazing to see the recovery in the market from so many people saying that the stock market was going to crash 20, 30, 40% even more and trying to dip in and out of the market, which is a topic that we'll touch on a bit later on when we discuss some more of those other stories. First things first though, the biggest story really of the past month was the US and China agreeing to pause the tariffs that they had retaliated against each other for 90 days. This sent the stock market into an absolute surge, and as you can see from the charts that I just looked at for the S&P 500 at least, we're back to nearly all-time highs not too far away. It's almost as if, like I said earlier, that things hadn't really changed and hadn't happened. Now, anything can happen moving forward into the future, and this is not a deal, this is just a pause of 90 days. But I did want to highlight the difference that this makes when you're thinking as an investor from a long-term perspective or a short-term perspective. In my opinion, tariffs and even presidential terms are all very much short-term things. At best, a presidential term is 4 years, and as a long-term investor, I'm hoping to invest for decades. I'm going to be investing through many different presidential terms, and I don't think any individual decision really should affect the way I invest. But again, more on that one a bit later. Now, as many of you will know, these pauses took those tariffs down from around 150% from the US on Chinese goods to down to not before the tariffs, it took them down to just a base level of 10%, which is still higher than they were before, but the markets are reacting as if, everything's fine and everything's sorted, which is still yet to be confirmed. Just remember that a tariff is imposed from the company who's importing those goods into the country. So for example, lots of small businesses in the US who may be importing a shipment, one container for example, of wall panels or toys or just plastic goods for example. Some of them were hit with some really big bills, and you can find lots of stories online about companies effectively, very small businesses, really being wiped out or just having to forego those goods entirely because with 140% tariff on them, there's really no profit and you're just basically throwing money away. The second biggest story out of the US was Moody's, the credit agency, has basically downgraded the US government from a AAA to a AA1. Now, this seemingly isn't really much of a big deal. Some people might make a big fuss out of things. I'll put you up on screen now just so you can see how this works. So effectively, the credit rating agencies, like they rate individuals, for example, and how credit worthy we are, will also rate countries, the country's debt, and they'll also rate companies too. So between now and then, I'll just show you the difference in how they rate different countries and also how they rate different companies. Now, is there really much difference between someone who's AAA and AA1? Is that really going to stop investors and people buying US debt from what is effectively the reserve currency of the world? I don't know really. I don't think much is going to change, but it certainly makes a big headline. Just for some reference, S&P Global, who also do credit rating as part of their business model, did put the US as a second layer down anyway, and they have been there for a while. So again, I don't know how much it really pays attention, and it certainly hasn't affected investors from any perspective that I can see, at least from a long-term investing standpoint. Some investors may be wary of it, but really, I can't see the US defaulting from their debt anytime soon. It would be an absolutely catastrophic thing to do, and the US has never defaulted on its debt, paying to those debt holders. Now, on this topic of timing the market and jumping in and out of the market with all the chaos that's been going over the past month, I have been keeping an eye on gold prices like many of you would have been. Now, as you will see on screen now, the price of gold over the past few weeks and the past month or so has really plummeted from its crazy highs and its crazy rally that it's been on for the past few months, and actually even over the past few years. Now, what this shows to me is that lots of people are either selling out of this commodity now finally because they're happy to deploy their money into the stock market, effectively just chasing the gains that we've seen recently. And I do fear that lots of people invested into gold because they saw it going up, they saw the stock market going down, and they thought, well, we're in for a long bear market now and things are going to go in the other direction. And many people, I fear, were chasing those gains and are probably now sat in the red, basically missing out on all of those gains in the stock market and now questioning themselves whether they should buy back in. Now, I have no idea, like anyone else, what the price of gold is going to do. over the long term. Likewise, I have no idea what the price of stocks are going to be. But I do know that gold doesn't produce any cash flow, doesn't produce any income. It can't make a new area of the market. It can't produce any new technology. And I do fear that people are chasing it just to make some profit. Let me just show you, for example, on the price of gold, just to show you the example of where I think people are playing around with things short term. If I play around with the price of gold versus an S&P 500 index fund based in the US, just so we can equalize things in dollars, you can see here the difference gold makes if on the short term, gold has outperformed the stock market. If we increase the terms, yes, it still has outperformed the stock market. But then when you go out to about 5 years or so, you can see how, although there has been certain periods, you see now the S&P 500 represented as a good representative of the stock market has beaten gold. Now, I think this is a really good discussion again about what long-term investing is and making sure that you get a portfolio right for you. But certainly, because gold has been in the news so much, I do fear that lots of investors jumped on this as if it was some magic bullet to protect the investment of their portfolio. Now, in the super long term, gold really is there to try and preserve your wealth, but it's still liable to the ups and downs of supply and demand. At the end of the day, the price of gold is just what someone else expected to pay for it. Very much in the same way as the stocks are too. But of course, stocks and businesses can at least have cash flows in the future. Now, the final story I wanted to cover off from a US perspective was there were lots of different news stories about different companies going on at the moment. But let me just dive into one that you saw a couple of weeks ago, and was Google. Now, if you have a look here, you can see that actually Google's share price fell around 7.5% in a day, which I believe is the largest fall in Google's history when you look back at daily share price drops. And this was led by a story basically saying that Apple were looking for different alternatives for the Google search engine, using things like AI, etc. And Google even came out on the day basically saying that no, search volume effectively is only going up, the business is only growing, etc. But I wanted to highlight this story really, not because specifically on Google, it's more around how we behave and how investors behave to a narrative that's put out, and all of a sudden one headline and one story can make the whole world bearish, and you had lots of people going on TV and lots of pundits and analysts will go on saying, wow, this is the end of Google, it's a company that isn't innovating anymore, and it might get overtaken by AI, etc. Now, I have no idea, of course, what will happen in the future, neither does anyone else, and that's a really important thing to say. But I do think short-term things like this are just so irrational and make no sense at all, and since then you can see how the share price has basically recovered. Now, the share price can do whatever it wants. At the end of the day, I'm not here to predict market moves, but I do just want to highlight how stories and narratives can really shape your behavior as an investor. And I think this is really, really crazy to change your behavior based on any short-term event or anything really. And I think if you want to be a long-term investor, it's so easier said than done. And stories like this can just get in the way. Now, jumping away from the US to the UK, on that topic of UK-US relations, effectively, I'm sure many of you will have seen the trade deal negotiated by the UK with the US, which effectively reduces and removes certain tariffs and really focuses on two key products, and that is the export of cars and the export of steel. Now, many of you won't know this, and I didn't really know what the largest export from the UK was to the US. I couldn't have really told you what it was in terms of goods, but it's actually cars making up a big chunk of what we export over to the US. I think that's mainly the luxury car brands. Correct me if I'm wrong. You have lots of Jaguar Land Rover products, so lots of those high-end ones. I don't think there's many other ones that get sent over, but maybe lots of you can correct me in the comment section. Then a large export section, steel, effectively had tariffs removed. Now, just going back to cars quickly, it's not like the original deal is particularly any better. Cars used to be 2.5%, they're going to go to 10%, which is that blanket level, but they're not going to go up any further from there. So I think it certainly can be a positive news to say that there is a trade agreement between the UK and the US, but that's not like a trade agreement ever stopped the US and the UK trading. The US is, by country, is UK's largest single trading partner. Now, if you add up all of the countries in the EU and put them all together, of course, the EU is actually the largest trading partner of the UK, being a neighbour, very so close, and being able to ferry goods and services so close across the channel. It's very much easier to do that than trying to ship physical products across the ocean, across the US. Just reading some comments from some different analysts here, got a quote saying, the actual substantive items that negotiated are pretty narrow. In some sense, you could say they basically took the status quo, made marginal changes and called it a deal. But I guess it's a deal nonetheless, and this may be part of the long-term strategy for Trump to go around the world and get different trade deals, which effectively are really no better than what it's had before, but will seemingly make an amazing deal. Now, the final story out of the UK that I thought was interesting just to look at, you might have seen that GDP growth came in at 0.7% rather than 0.6%, which was forecast. Now, lots of people made a huge song and dance about this as if the UK is growing again, everything's great, and we should all just not worry about things, and the UK is soaring high, everything's absolutely fine. Now, I never kind of look at these figures from a monthly perspective and a quarterly perspective and get too excited. The biggest reason is that these figures often get revised, and the revision can be anything from, I mean, it could be a 0.5%, it could even be a single percentage point revision, which would mean that basically these things can be wiped out either on the downside or on the upside. I think the important thing really is long-term trends of growth, which are very certainly important for all of us to pay attention to, but I don't think that any single person or government or action can necessarily be taking credit for the growth that's taking place in the short term. I'm always cautious of those things. It's very nice to see growth, don't get me wrong, but that growth can be just changed and revised at any point, and it frequently is. But when the data does get revised, it's not like a new news story comes out that we go back to look at things anyway. Also, a key thing to note is that data is always going to be backwards looking, and ultimately when this data came out, the effects of the tariffs and different global supply chains hadn't came into effect. So again, I don't pay too much attention to these things, but I did want to highlight it, and it doesn't necessarily mean good or a bad thing. If you're a long-term investor, personally, I don't think it changes anything. You stick with the plan and stick with what you're doing. Okay, on that note, let's have a look at my Vanguard portfolio and see how things have changed and got on from the month. Now, as you'll see on screen, I have 2 accounts with Vanguard, but effectively, really, all that matters is my pension. Now, the reason I hold my pension with Vanguard, and it's a self-invested personal pension, is I actually contribute money every single month from my limited company. It's an extremely tax-effective way to invest because pension contributions are a tax-deductible expense, which is a really nice thing. And the way I look at it really is every time I invest into my pension, I'm already ahead because that money is not subject to any corporation tax, and it's also not subject to any personal taxes from my side. There's no income tax to pay and there's no dividends tax to pay. It can just go straight into my pension. Now, as you can see, it's crossed recently the £90,000 mark, which is a nice thing to see. It will be cool to go and see it making into the 6 figures. But the biggest reason that it will be going up quickly like this is really going to be coming from contributions on my side rather than necessarily the market going up or down. As I've said many, many times, I invest every single month no matter what the price is. And effectively, that is a long-term strategy of dollar cost averaging no matter what, because I don't know what the market's going to do. I can't time the market and no one else can. Lots of people do claim to believe they can, and you'll still find people in the comment section who claim to know things about the market and what's going to happen in the future. We should also ask these people for the Euro Millions numbers. Please do let me know in the comment section. So just on that, before we go into the performance section, let me just show you what I normally do. So as you can see here, the last time I put money in, I put £3,000 in on the 2nd of May. That was actually my first contribution in this new tax year. We'll see a couple of larger inputs of £10,000 at the end of March. Now, I did this specifically because of the tax year and had money spare in my limited company. And I was thought, right, rather than pay myself money, really, I wanted to get it into this. It's a much more effective way. It's a good tax efficient way to build wealth. So that's why you might see that here, rather than saying I'm trying to time the market. In fact, it wasn't really a good market time if that was the case. Really, it would have been better at the start of the financial year, but that would have then gone into the new financial year. Then before that, I've been fairly consistent and invested as much as I can. Around this sort of mark, about the £3,000 or £4,000 mark is where I'll try and keep it. Try and max out that up to £60,000 that you can put into your pensions each year, which include tax relief, by the way, just to let you know on that one, up to 100% of your income. Let's have a look at performance now, the total figure, and you can see what it's actually cost me and the changes in that. If I go to the performance tab, it's always an interesting one to see month by month because there were so many variations, and last month's update and a couple of months updates before that have been really interesting to see the variations that you have to basically go through as a long-term investor, because even as a long-term investor into a global index fund, a simple global index fund, it's not easy. You're going to experience some huge ups and downs. And can you imagine what you have to go through if you want to invest in individual companies? It's even crazier and even wilder than that. So as you can see, the last 3 months effectively have been really, really poor. You can see in February, March and April, every single month, the value of the portfolio was going down. And at one point, you can see here that the portfolio was down in the mid 60s. And money was added, yes, but money was added during the time when there was negative returns, and this can easily make lots of people very nervous. But as a long-term investor, I don't really care, to be honest. And I think that's a really important thing that you need to remind yourself. Very much easier said than done. Then you can see here that May was such a good time in the stock market that personal investment returns returned to green, 5,000 here, and then they brought up the cumulative returns to 12,829. which isn't a million miles away from where we were back in the peak. As you can see here, around that January time, there were £15,480 worth of gains in the account. Now, like I've said many times, I'd pay absolutely no attention to these. These are unrealized gains and losses. They don't make me feel any richer or poorer. They have no impact on my life whatsoever. And as a positive thing, I guess, from a pension perspective, I can't touch this money anyway, which is a good thing. Yes, I could make some terrible decisions and sell out of these investments and transfer the money to another pension provider where I could invest in individual stocks and make terrible decisions and keep it as cash. But actually being in a pension helps me as a long-term investor make better decisions. And I am just going to continue to make sure that I invest consistently, regularly, every single month. Now, out of interest, if you're new and you're a bit more curious about what I'm investing in my pension at least, I keep things really simple. And I buy this fund, which is the FTSE Global All Cap Index Fund. And specifically, it's the accumulation version of this fund. Basically invests in pretty much every single company around the world by their market cap. So the larger the company, the more of my money will go into that. And because it's an accumulation fund, I don't get paid any dividends. Everything just gets reinvested. And over the long term, I would expect this fund to try and deliver me the returns of the market, which sound crap and sound like I'm going to get an average level of return. But if you look at the statistics, most people don't get anywhere near the average returns of the market because they jump in and out. And I'm going to hopefully do much better than most people, and I hope you will join me as well and do what's right for you and make sure when you're investing to make something that's right for you too. Interestingly, on this chart you can see on screen are the green dots, basically where I've put all my investments in. Because I just do dollar cost averaging, sometimes I get nice bottoms of the market and sometimes I invest at terrible points right at the high. For example, you can see on screen now, when I put my £10,000 in before the end of the tax year, this was just before the crash. I didn't know that was going to happen. Who cares? And then, for example, other periods I've got near all-time highs again. Other periods I've seemingly timed the market amazingly at the 4th of November and got the bottom of the dip. I do not care what the price of this investment is. Really, all that matters is me as a long-term investor. And I am hoping that in the long term, we're able to beat inflation and do a little bit better than that. But I have no idea. But it's important to make sure that I stick long-term with the plan. Now, if you are quite new to investing and some of this has gone over your head and I've been using too many technical terms, don't panic. I've got loads and loads of videos on my channel to help you. If you are a beginner and you just come across these things, because it's very intimidating and there's a lot to worry about and there's a lot at stake. So I do have a very nice, easy how to invest for beginners video, which I'll put up on screen now. And then if you're a little bit more advanced, I do also have some ideas for investments too, where I've done a video about the best funds and how to decipher those different things, whether you're looking at them. But anyway, I will leave you with that one. Thank you so much for watching. And as always, happy investing.